Inventory Valuation Indistinguishable Goods Learning Quiz. And these are the questions to test your understanding of concepts for inventory valuation. The first one, explain how cost of sales and inventory valuation are determined under the following accounting methods. So FIFO, LIFO, and average cost. So under FIFO, cost of sales is based on the cost of the oldest inventory, the first one in, the first one's out. And the inventory valuation is hence weighted towards the cost of the most recent purchases. And LIFO, last in, first out, cost of sales is based on the cost of the most recently bought inventory. And the inventory valuation is then weighted towards the cost of the oldest purchases. And finally, AVCO, average cost. The cost of sales is based on the average cost of all inventory bought, and inventory valuation is based on historic average cost. And which accounting method, LIFO versus FIFO, will give the higher profit when prices are rising? Justify your answer. And FIFO will give the higher profit. And we can explain that because under FIFO, the cost of the older, cheaper stock will be taken through as cost of sales. While in LIFO, some of this will be left in inventory and the newer, more expensive stock taken through as cost of sales. Give 5 principled reasons to support the case for the abolition of LIFO in the US. And more than 5-year LIFO does not reflect business practices. Companies sell their oldest inventory first, not their most recent. And a consequence of this accounting treatment is that it appears that part of the inventory is never sold for firms which don't take their inventory down to zero. And it can result in seriously understated inventory valuations and hence understatement of inventory. It makes international comparison of firms' performance harder if some firms in the US are using LIFO and firms in the same sector internationally are following IFRS where LIFO is prohibited. They'll be following FIFO or AVCO. It's always harder when firms are using different accounting standards. And it's an obstacle to IFRS US GAAP convergence because of this fact that LIFO is prohibited under IFRS. And it has been shown that it's an incentive for inefficient stock practices. Firms keep more stock than they need to maximize or improve their tax advantage from holding more stock. And finally, it's unfair to firms that trade in identifiable goods that have already been taxed on the profits from inflation that they have earned. Explain how net residual value is arrived at. And net residual value is simply expected selling price minus cost to completion. And lastly, under different inventory valuation methods, a firm's inventory is reported at £12,000 under LIFO, £25,000 under FIFO, and £14,000 under AVCO. The net residual value of the inventory is determined to be £15,000. Following the revaluation, what value should the stock now have in the statement of financial position under each of these 3 methods? So under LIFO, it should remain unchanged because the current book value of £12,000 is less than the net residual value. For FIFO, it needs to be written down from £25,000, the current book value, to the £15,000 net residual value, and it is unchanged for AVCO. The current book value of £14,000 is less than the net residual value of £15,000. And those are the questions that we've just looked at.